You've probably seen the number, $630,000. That's what ASFA says a single person needs to retire comfortably in Australia at 60. If you're a couple, the figure is $730,000. These numbers get quoted everywhere, in newspaper articles, on comparison websites, in conversations with financial advisors. And if you've been using one of those figures as your retirement target, you're not wrong to trust it. But that number has a quiet assumption built into it that most people never notice. It assumes you're retiring at 67, not 60, because 67 is when the age pension kicks in. Retire at 60, and you've got 7 full years where the government provides you with nothing. Zero. Every dollar of rent, food, power, medical, and travel has to come from your own savings. At $60,000 a year in spending, which isn't extravagant, that's a reasonable retirement lifestyle. That 7-year gap costs you $420,000 before you receive your first age pension payment. That's $420,000 that has to come from super alone before any government support arrives. So if you're planning to retire at 60 and you've been aiming at $630,000, you're working with an incomplete map. The destination hasn't changed. But the distance is longer than the sign says. Let me show you exactly why that number leaves you short, what the gap actually costs, and what a realistic target looks like once you account for the 7-year hole. Here's the mechanism most guides skip over. When you retire at 60, you can access your super. You've hit preservation age, so the money is legally yours to draw from. But you won't receive a single dollar from the age pension until your 67th birthday. That's 7 full years where every cent of rent, food, utilities, and medical has to come from your own savings. ASFA's Comfortable Retirement Standard puts annual spending for a single person at $54,840 a year. That's their figure for a comfortable lifestyle. Not lavish. Comfortable. 7 years of that comes to $383,880 in living costs during the gap alone. If you want to travel in those early years, if you want some flexibility, call it $60,000 a year. Now the gap costs $420,000. And that's before you've spent a single dollar after age 67. I used to think the ASFA number was the finish line too. I remember sitting down with my own projections at 58 and realizing the same thing that catches most people out. The gap changes everything about what's a safe balance to retire on. Take Rob. He's 59, an electrician from Newcastle with $640,000 in super. He planned to retire at 61, and that $640,000 felt like enough. It's above the ASFA benchmark. But Rob hadn't done one calculation. How much of that balance disappears during the 7-year bridge before the pension kicks in? If Rob draws $60,000 a year from 61 to 67, that's $360,000 gone from his super before the age pension arrives. At 67, he'd be left with roughly $280,000 in super, assuming modest investment returns during that period. At that level, he qualifies for a part age pension, not a full one. His discretionary income drops significantly. The travel he planned for his early retirement gets quietly shelved, not because he spent recklessly, but because no one told him the $630,000 figure assumed government support starting at 67. The resilience path looks different. You account for the gap before you retire. You build a dedicated bridge strategy, a pool of money specifically set aside for those 7 years, so your growth super can keep compounding untouched for as long as possible. You model the age pension into your plan from day one, not as a surprise bonus, but as a structural support that arrives at a known date. The money you need in retirement doesn't change much between the two paths. What changes is whether your super lasts long enough to get there. But even if you account for the gap, there's another variable that the $630,000 target completely ignores, and it's the one that can quietly destroy your plan within the first 5 years of retirement, even if you've saved the right amount. Most retirement calculators give you a single input, expected annual return. You type in 7% or maybe 6%, and the calculator projects that rate smoothly across 25 or 30 years. It looks reassuring, a straight line climbing up and to the right. The problem is that markets don't move in straight lines, and when you're in the drawdown phase of retirement, the sequence of those returns matters enormously. Here's how the mechanism works. If you start retirement with $700,000 and the market drops 20% in your first year, your balance doesn't just fall to $560,000. You're also drawing $38,500 a year to live on. So you're selling units at their lowest price to fund your expenses. The balance after year one is closer to $521,500. The market then recovers. It goes back to delivering 7% a year, but it's recovering on a smaller base. You never fully claw back what was lost. Over 25 to 30 years, that single bad year at the start can reduce your total lifetime withdrawals by roughly 28% to 32% compared to someone with the exact same average return but no crash in their first 5 years. That's not a projection. That's the structural reality of drawing down a shrinking portfolio during a recovery. The ASX 200 dropped around 40% from peak to trough during the 2008 global financial crisis. Someone who retired in January 2008 with $700,000 in super and started drawing $50,000 a year would have seen their balance fall to roughly $380,000 by March 2009, even before accounting for inflation. Their income capacity was permanently reduced. That same retiree, had they retired in 2013 with the same $700,000 and the same spending level, is still drawing today with money to spare. Same starting balance, same spending. Completely different outcomes, based purely on when the market chose to fall. I remember watching a mate of mine go through exactly this. He retired in January 2008 with what he genuinely believed was a bulletproof plan. By mid-2009, he was back working part-time at a hardware store. Not because he needed the money for groceries, but because the fear of running out was worse than the reality of going back to work. He didn't run out of money. He ran out of confidence in his plan. This is why the $2 million target everyone quotes can still fail you. It's a balance number. It says nothing about the sequence in which the market delivers its returns. A $2 million portfolio that gets hit with a 25% crash in your first year of retirement is not the same as a $2 million portfolio that grows for 3 years before any correction. So, what does a protected retirement actually look like? How do you build a plan that survives a crash in year one? It comes down to one structural change, and most people have never heard of it. Let me make this concrete with 2 people. Same age, same super balance of $700,000, same spending needs of $55,000 a year. The only difference is how they've structured their money. Person A has everything in a single growth portfolio. When they retire, all $700,000 is invested in a balanced or growth fund. The market drops 22% in their first year. Their balance falls to $546,000. They still need $55,000 to live, so they sell units at the bottom to fund their expenses. After year one, their balance is roughly $491,000. Over the next 2 years, the market recovers, but it's recovering on a smaller base than it started with. By year 3, even with a partial recovery, their balance is sitting around $480,000. Their income capacity for the rest of retirement is structurally lower. Person B had the same $700,000, but split it before they retired. They put $140,000, roughly 2 years of essential living expenses, into a cash-based account. their growth portfolio started at $560,000. When the market drops 22%, their growth portfolio falls too. But they don't touch it. They draw from the cash account to fund year 1 and year 2. By year 3, the market has recovered. They replenish the cash bucket from the growth portfolio at recovered prices. They never sold a single unit at a loss. Over 25 years, that single structural decision, how the money was arranged on day 1, can be worth $150,000 to $200,000 in additional income. Not because person B was smarter about picking investments. They had the same investments. The difference is that person A was forced to sell low, and person B wasn't. This is what a cash bucket strategy actually does. It's not about earning more. It's about not being forced into the worst trade at the worst moment. I built a cash bucket into my own retirement plan after watching my mate go through 2008. Keeping 2 years of spending in cash costs you some potential growth. Cash doesn't compound the way equities do. But it means you never face the situation where the only way to pay your electricity bill is to sell your super units at 60 cents in the dollar. The peace of mind that comes with knowing your income is covered regardless of what the market does on any given Monday morning is worth far more than an extra percentage point of return. The cash bucket is step 1. But there are 2 more levers that can reduce the total super balance you actually need, and most people have never heard of either of them. Once you understand the gap and the sequence risk, 3 practical levers change the total super balance you actually need to retire at 60. None of them are complicated. All of them are commonly missed. The first is the cash bucket we just covered. For someone with Rob's situation, planning to spend around $55,000 to $60,000 a year in retirement, 2 years of essential expenses works out to roughly $100,000 to $110,000 held separately in a high-interest savings account or a conservative option inside an account-based pension. That money sits outside your growth portfolio and covers your income during any market downturn in the early years. It's the structural protection against being forced to sell at a loss. The second lever is part-time work during the gap years. And this one surprises people. Working just 15 hours a week between age 60 and 63, earning around $25,000 a year, has a dramatic effect on how much you need to draw from super during the 7-year bridge. Over 3 years, that's $75,000 in income that comes from work rather than from your super balance. Instead of drawing $420,000 from super during the full gap, you're now drawing closer to $345,000. That's a significant reduction in the balance you need on day 1 of retirement. And the secondary benefit is real too. Staying socially connected in the early years of retirement turns out to matter more than most people expect. The third lever is the transition to retirement pension, or TTR. If you're still working at 60, you can start a TTR pension and draw up to 10% of your super balance per year while continuing in paid work. The strategy works like this. You salary sacrifice a portion of your income into super, paying 15% contribution tax rather than your marginal tax rate. You then replace that sacrificed income with tax-free TTR pension payments from your super. The net result is that more of your money flows through the tax-advantaged super system while your lifestyle stays exactly the same. It's not complicated, but it requires actively setting it up, and most people simply never do because they don't know it's available from age 60. Taken together, these 3 levers, the cash bucket, part-time work, and the TTR pension, can reduce the total super balance you need to retire at 60 by somewhere between $150,000 and $250,000 compared to what the standard advice suggests. But there's one more thing stopping most people from ever using these levers. And it's not the complexity. It's something quieter than that. The three levers in the last section are not complicated. None of them require a finances degree. So why do most people never use them? The honest answer is that they never model the numbers in the first place because looking at the numbers feels too risky. When you see $630,000 as the benchmark and your super balance is $410,000, your brain doesn't immediately start looking for solutions. It goes somewhere else first. It goes to, I've already failed. And once you land there, you stop looking. Not because the situation is hopeless, but because the feeling of being behind is genuinely painful, and avoidance is the natural response to pain. If you've been putting off opening your super statement, you're not lazy. You're protecting yourself from a number you believe will confirm your worst fears. I've been there. A lot of people I've spoken with over the years have been there. It's completely normal. But here's what the ASFA number doesn't tell you. $410,000 with a solid gap strategy, a couple of years of part-time work, and a properly structured age pension plan can fund a real retirement. It looks different from the glossy brochure version, but it's not failure. It's a plan that works with what you actually have. The shift that changes everything is this: stop asking, do I have enough? And start asking, what can I make work with what I have? The first question leads to paralysis because there's no clean answer. The second question leads to a plan because it has one. I don't know your exact situation. I don't know your health, your mortgage, whether you've got a defined benefit scheme from an old employer, or what your partner's super looks like. But I do know that the number that's been scaring you is almost never the right number to be looking at. Run your real numbers once with the age pension, part-time work, and a cash buffer factored in. You might be a lot closer than you think. The gap between where you are and where you want to be is almost always smaller than it looks from a distance. So here's what we've covered. The $630,000 ASFA benchmark is a starting point, not a finish line. Because retiring at 60 means you're funding a 7-year gap before the age pension arrives, and that gap alone can cost $420,000. The market's sequence of returns can permanently reduce your income, even if your long-term average return is exactly what you planned for. A cash bucket protects you from being forced to sell at the wrong moment. And the three levers, cash bucket, part-time work, and a TTR pension, can reduce the super balance you actually need by $150,000 to $250,000 compared to the standard advice. Retirement planning isn't about finding a magic number and hoping you hit it. It's about building a structure that works with your actual life, one that survives the things the calculators don't show you. Real numbers, real Australian rules, no American formulas that don't apply here. That's what we build every video around on this channel. If you're in that 55 to 65 window and you want to understand your real retirement number, not the benchmark, your number, hit subscribe. We run the real scenarios here.